When I first saw the news that NVIDIA had spent $112 billion on an acquisition, I felt a deep sense of disbelief. Not the kind that comes from surprise, but the kind that comes from having seen this movie before. The same story played out in slightly different actors and costumes, yet always ending the same way. This isn't just a matter of numbers on a balance sheet. This is the kind of financial decision that reflects a deep-seated delusion, a mania that's gripped not only management but the broader market, a collective blindness to reality. I've spent decades dissecting the way capital flows, the way investors chase trends, without any connection to intrinsic value. And this deal is a textbook example of that phenomenon. $112 billion is not a rounding error. It is an entire market's worth of opportunity squandered if mismanaged. It's staggering, and yet no one seems to question it. To understand why this is madness, you need to look past the headlines in the press releases. NVIDIA's acquisition is being framed as a strategic play, a move to consolidate technology, to secure a future in AI and high-performance computing. Wall Street loves this language. It's comfortable, digestible, and vaguely reassuring. But numbers, cold hard numbers, do not lie. When you start breaking down the cost, the integration risks, and the market realities, the story becomes far less rosy. The first problem is the sheer scale of the deal. $112 billion in any context is enormous. But here, it represents a significant portion of NVIDIA's market capitalization. To finance a deal of this magnitude, even with cash on hand, NVIDIA is either over-leveraging itself, diluting shareholder value, or taking on extraordinary risk. And let's be honest, in today's market, extraordinary risk is rarely priced correctly. Now, I don't doubt that the acquired assets may have value in isolation. They may even be strategically interesting, but that is not the same as justifying $112 billion. Too often, executives confuse strategic rationale with financial prudence. They think that a big, transformative acquisition automatically translates to shareholder gains. History tells us this is almost never the case. I've seen this movie during the dot-com era, during the housing bubble, and in countless other instances where corporate leaders, intoxicated by the applause of analysts and the euphoria of rising stock prices, make moves that are spectacular on paper but catastrophic in reality. The scale here doesn't change the rules. In fact, it amplifies the risk. What worries me most is the market's response. NVIDIA's stock jumped on the announcement, not because the deal was wise, but because investors are eager for a story. They're chasing momentum. They see AI as the next frontier, and the logic goes, if we buy into the hype, we won't miss out. But that's speculation masquerading as investment. I don't invest in stories. I invest in mispricings. And a $112 billion acquisition made at a peak in market enthusiasm is a glaring mispricing in the making. Investors are paying for expectations that are optimistic to the point of fantasy. Even if everything goes right, perfect integration, continued revenue growth, global market expansion, the price paid leaves almost no margin for error. Any deviation from these assumptions and the financial consequences could be severe. Then there's the timing. NVIDIA made this deal at a moment when valuations across tech are stretched, interest rates are rising, and macroeconomic signals are uncertain. This isn't a company buying when prices are depressed. This is a company buying at the top, in a market that is increasingly irrational. $112 billion isn't just money. It's the summation of assumptions about future growth, profit margins, and technological dominance. And the problem with assumptions is that they are almost always wrong. History shows us that companies that spend massively at the peak of market enthusiasm rarely see a payoff proportional to their outlay. They often face years of write-downs, restructuring, and shareholder discontent. Yet, somehow, the market applauds in real time, oblivious to the underlying risks. Let's consider the integration challenges. When a company buys another of this size, it's not just about transferring assets or combining operations. It's about culture, management, technical synergy, and execution. Integration risk is one of the most overlooked variables in mergers of this magnitude. It's not sexy, it doesn't make for press releases, and it doesn't appear in quarterly guidance. But it is lethal. A $112 billion acquisition is not a small addition, it's a seismic event. Aligning teams, technologies, and business models across such a scale is enormously difficult. Any misstep, any failure to realize anticipated synergies, and a large portion of the purchase price evaporates. And yet, in today's market, integration risk is often assumed away, as if management has some magic wand that guarantees perfect execution. Reality doesn't work that way. From a financial perspective, the valuation metrics are troubling. To justify $112 billion, NVIDIA must achieve growth rates and profit margins that are, frankly, heroic. Analysts are projecting an extended period of outperformance in AI, gaming, and data center operations. But projections are not facts. I've learned the hard way that forecasts are usually optimistic. Executives and analysts have a strong incentive to paint the picture as bright as possible. But when the actual numbers arrive, the market is suddenly confronted with a harsh reality. $112 billion spent on an assumption is not a strategic win. It's a bet that the future will behave exactly as hoped, with zero room for error. And then there's leverage. If NVIDIA took on debt to finance this acquisition, even partially, the company now carries a financial burden that constrains flexibility. In an environment where interest rates are elevated, debt is not free. Servicing large debt can erode cash flow and force difficult decisions if revenues don't meet expectations. If they finance through equity, existing shareholders are diluted. Either way, the transaction has consequences that affect the company's financial health for years. Yet this doesn't seem to register in market reactions, which focus narrowly on growth narratives. We also have to consider opportunity cost. $112 billion is not a small sum. This money could have been deployed in research and development, in smaller acquisitions with better returns, in dividend growth, or in share buybacks that directly reward investors. By allocating capital in this manner, NVIDIA is locking in a very large, illiquid bet. If the acquisition fails to deliver commensurate returns, the company not only loses money, but also misses alternative opportunities that might have produced substantial shareholder value. The market rarely accounts for opportunity cost, but for someone trained to think in terms of real returns, this is a glaring inefficiency. Perhaps most alarming is the hubris. There's a sense that management believes they can outsmart the market and create value simply through size. They equate a large price tag with strategic brilliance. But I've seen many companies fall into the same trap, thinking scale confers invincibility. It doesn't. Execution remains the deciding factor, and the larger the deal, the smaller the margin for error. $112 billion is not a protective moat. It's a magnifying glass for mistakes. In short, this acquisition is madness not because the underlying assets lack value, but because the price, timing, and assumptions make it extraordinarily risky. NVIDIA's management is gambling with the future of the company, and the market is applauding without understanding the stakes. I've spent my career identifying these situations, the moments when collective enthusiasm overrides rational analysis. This is one of them. To anyone paying attention, the lesson is clear. Magnitude does not equal safety. Popularity does not equal prudence. And a narrative that sounds convincing in a press release often hides fundamental risks that can destroy value over time. $112 billion is a figure large enough to make headlines, but it is also a figure large enough to make mistakes fatal. History shows us that markets eventually wake up from these delusions, sometimes brutally. NVIDIA may be able to execute flawlessly, but the probability of perfection at this scale is low. The sensible investor should be wary, skeptical, and prepared for a reality far less forgiving than the story being sold. Why Wall Street is blind to this risk. Wall Street is blind to this risk because it has developed a pathology of optimism, a cognitive bias reinforced over decades of rising markets, easy money, and short-term thinking. The structures of modern finance, investment banks, sell-side analysts, institutional investors, and media are all aligned in a way that punishes skepticism and rewards conformity. If you question the logic behind a $112 billion acquisition, if you point out the inherent leverage, the risk of integration failure, the unrealistic growth assumptions, the industry euphorics, you are immediately cast as contrarian, bearish, or simply missing the narrative. Yet this narrative, this collective delusion, is what blinds the very institutions that are supposed to evaluate risk. They are functioning not as gatekeepers, but as cheerleaders for the status quo. To understand why Wall Street cannot see this risk, you have to understand incentives. Analysts are rewarded for optimism. Their pay, their promotions, their public profile depends on producing favorable ratings. If an analyst downgrades a stock or questions the wisdom of a mega deal like NVIDIA's, they risk alienating management, losing access, or appearing out of step with the market consensus. This is particularly acute in high-profile tech stocks, where narrative dominates numbers. Analysts are incentivized to maintain the illusion that every acquisition, every new product, every trend is a guarantee of continued growth. There is a cultural blind spot, a structural distortion that conflates bold moves with intelligent moves and equates scale with invulnerability. Institutional investors are equally susceptible. Fund managers are evaluated primarily on relative performance, not absolute returns. Underperformance relative to benchmarks can result in lost capital inflows, scrutiny, and career consequences. This creates pressure to chase trends and maintain positions in popular stocks, regardless of whether the underlying fundamentals support the enthusiasm. A $112 billion acquisition becomes a convenient excuse to continue riding the momentum of NVIDIA, because selling or shorting would mark you as a contrarian, a career risk, and in the short term, the market usually rewards conformity. In effect, the system punishes independent risk assessment and incentivizes herd behavior. Then there's the media ecosystem. Financial journalism amplifies hype. Every press release from NVIDIA or other market leaders is dissected, summarized, and presented as evidence of brilliance. The headlines scream strategy, innovation, growth, dominance. Few journalists have the training, time, or incentive to examine assumptions, challenge valuations, or model worst-case scenarios. The public consumes these narratives as fact, not opinion, which reinforces the market's collective blindness. The coverage itself becomes part of the problem, turning a risky acquisition into a symbol of inevitable success. Wall Street's historical amnesia also plays a critical role. Executives, analysts, and investors behave as if previous bubbles never happened, or they discount them as anomalies. They look at recent market, history AI breakthroughs, massive returns on tech stocks, the rapid growth of semiconductors, and extrapolate as if trends will continue indefinitely. The memory of the dot-com crash, the housing bubble, the financial crisis, even the correction in 2022, fades quickly. Humans are remarkably poor at remembering how quickly enthusiasm can turn into disaster. This forgetting is institutionalized, as younger analysts rise through the ranks having never experienced a major collapse firsthand. As a result, they view $112 billion acquisitions as natural, reasonable, and necessary, rather than as extreme risk events. Cognitive biases further cloud judgment. The availability heuristic makes recent success stories dominate perception. The anchoring effect leads investors to fixate on past stock performance, using it as a benchmark for expected future returns. Confirmation bias ensures that everyone seeks out information that validates the bullish narrative while ignoring signals that suggest overvaluation, leverage, or execution risk. Social proof compounds this. When everyone around you is buying, predicting growth, and celebrating the deal, it becomes psychologically difficult to dissent. The collective reinforcement of these biases produces an echo chamber in which risk is invisible. In addition, complexity obscures risk. Modern financial instruments, accounting structures, and corporate strategies are opaque. Analysts and investors rely on models that are often black boxes, assuming that management's projections are accurate. The $112 billion acquisition is not simply a line item. It involves forecasts of revenue growth, market share gains, R&D synergies, talent retention, and global expansion. Each assumption is contingent, each integration step uncertain. To model all these variables accurately is extraordinarily difficult, and the slightest deviation can render projections meaningless. Wall Street simplifies this complexity into headlines and earnings guidance, creating the illusion of certainty where none exists. Another factor is regulatory and governance pressure. Large institutional investors, pension funds, and mutual funds are often constrained by mandates, risk limits, or peer behavior. They may feel compelled to maintain positions in NVIDIA or participate in follow-on investments to avoid underperformance relative to indices. This collective action problem means that even if a few individuals recognize the risk, they are powerless to act, further reinforcing the market's collective blindness. History is filled with examples where Wall Street overlooked risk because of structural incentives. In 2007, banks piled into mortgage-backed securities, convinced that risk was under control. Ratings agencies reassured the market, and regulators failed to act. In 2000, analysts and investors celebrated dot-com companies with little revenue, projecting infinite growth. In each case, rational analysis was suppressed by incentives, social proof, and cognitive biases. NVIDIA's acquisition shares many of the same warning signs: extraordinary size, reliance on optimistic projections, euphoric market sentiment, and structural reinforcement of optimism. Yet the collective reaction today mirrors those moments of irrational exuberance. Cheerleaders everywhere, skeptics ignored, risk invisible. What is perhaps most concerning is the feedback loop. When Wall Street fails to recognize risk, it validates management's behavior, encourages more aggressive spending, and inflates stock prices. Investors interpret rising valuations as confirmation that the acquisition was wise, rather than as evidence of collective misjudgment. The higher the stock climbs, the more entrenched the narrative, the more difficult it becomes for dissenting voices to be heard. This is precisely the mechanism that transforms rational caution into apparent foolishness. Skepticism is punished, optimism is rewarded, and risk is obscured until it is too late. Finally, consider the role of institutional herd behavior in suppressing dissent. Large funds and asset managers often move in tandem, buying and selling the same high-profile stocks to avoid tracking error relative to benchmarks. This amplifies price movements and creates the appearance of consensus. Independent voices that raise alarms about overpayment, integration risk, or unrealistic growth assumptions are drowned out by the magnitude of institutional flows. The market's collective blindness is not accidental. It is a structural byproduct of modern finance. In short, Wall Street is blind because the system is designed to be blind. Incentives favor optimism over skepticism, narrative over analysis, conformity over independent thought. Analysts, fund managers, and journalists are all participants in a reinforcing loop that celebrates mega deals and ignores risk. Cognitive biases, historical amnesia, and complexity all contribute to the inability to see the dangers inherent in a $112 billion acquisition. Investors and the public are encouraged to believe in a story rather than in numbers, to cheer rather than to question, to follow rather than to think. This is why the deal can be celebrated as brilliant while exposing the company and its investors to enormous potential downside. The true value of NVIDIA versus when you strip away the press releases, the hype, the glowing analyst commentary, and the endless optimism about artificial intelligence, gaming, and data centers, what you are left with is a company that has a measurable, finite intrinsic value. That intrinsic value is based on its current earnings, cash flows, balance sheet, and the realistic growth trajectory of its products and markets, not on the inflated projections sold by Wall Street, not on the narrative that NVIDIA is somehow indispensable to the AI revolution, and certainly not on the idea that a $112 billion acquisition magically multiplies worth. The difference between true value and market hype is often invisible in the short term, but it becomes painfully clear when expectations fail to meet reality, when assumptions collapse, and when the market finally recalibrates to the underlying fundamentals. Let's start with the fundamentals, because these are the only things that matter. NVIDIA is a company that designs and manufactures graphics processing units, specialized AI chips, and other high-performance computing products. Its growth over the past decade has been impressive, no doubt. Revenues have soared, profit margins have expanded, and its stock price has reflected this success. But the question is not whether NVIDIA has grown in the past, it is whether its current valuation and acquisition strategies reflect true value or a projection that borders on fantasy. When I analyze a company like NVIDIA, I begin with a simple question. What is the present value of all future cash flows that this company can realistically generate? Every other consideration, market hype, strategic narratives, potential acquisitions, is secondary to that. The first point of concern is the premium investors are paying for expectations rather than actual results. The market has elevated NVIDIA's stock price based on assumptions of sustained hypergrowth in AI and data centers, assumptions that are highly uncertain and dependent on multiple external variables. These variables include the pace of AI adoption, competition from other semiconductor companies, potential regulatory changes, supply chain stability, and global economic conditions. Each of these factors introduces risk, and yet the market seems to ignore them. Instead of pricing the stock based on achievable earnings, Wall Street prices it on the story that NVIDIA is indispensable to the future of technology. Stories are seductive. They are easier to sell than models that require careful analysis, but they are not investments. Next, consider the acquisition. $112 billion is not a minor expense. It represents roughly a third of NVIDIA's current market capitalization. To justify this expenditure, the acquired assets must immediately enhance revenue and profit in a manner that materially exceeds the cost of capital and the risk inherent in integration. Yet when we examine these numbers critically, it becomes evident that the assumptions baked into the market's optimism are extraordinarily aggressive. Even a modest delay in integration, a slight shortfall in projected revenue, or an unforeseen competitor's innovation could erode value dramatically. In other words, the acquisition amplifies the gap between true value and market perception. It is an exercise in optimism rather than prudence. Let's dig deeper into the concept of intrinsic value. A company's intrinsic value is the sum of its discounted future cash flows. This is not subjective storytelling. It is a measurable, finance-based calculation. For NVIDIA, one must account for current earnings, the potential growth of its GPU and AI chip markets, the longevity of product cycles, and the probability of continued technological leadership. When I model these factors conservatively, using realistic adoption rates and reasonable margins, the resulting valuation is significantly below the market's current pricing. The gap between intrinsic value and market price is not small, it is substantial. This is where the market hype obscures reality. The market is effectively pricing NVIDIA for perfection, assuming flawless execution, zero competition, and uninterrupted exponential growth. In reality, perfection is rare, and the slightest deviation can lead to a steep decline in stock price. Another critical factor is competition. NVIDIA's dominance is real, but it is neither absolute nor unassailable. Competitors such as AMD, Intel, and a host of specialized AI chip startups are aggressively pursuing market share, developing alternative architectures, and in some cases, offering comparable performance at lower cost. Market hype often ignores this, presenting NVIDIA as a monopoly in AI chips, but reality is far more nuanced. Market share gains are never guaranteed, and technological superiority is fleeting. A single misstep in product development or a successful competitor innovation could erode margins and limit growth. True valuation must account for these competitive risks, not assume that NVIDIA's market position is permanent. Then there is the issue of cyclical risk in semiconductors. NVIDIA's revenues are heavily tied to consumer and enterprise technology spending, which is inherently cyclical. Economic slowdowns, inflationary pressures, or geopolitical disruptions can reduce demand for high-end GPUs and AI chips. Analysts often downplay these macro risks in their models, assuming uninterrupted demand growth. But history shows that tech cycles are volatile, and companies that fail to anticipate downturns can experience rapid declines in both revenue and stock price. Market hype, by contrast, discounts these risks entirely, creating a disconnect between reality and valuation. The integration of the acquisition itself presents a second layer of risk. Acquisitions rarely go as planned. Cultural mismatches, technological incompatibilities, and operational misalignments are almost inevitable. Every large merger introduces complexity, slows decision-making, and distracts management from core operations. The larger the acquisition, the greater these risks become. NVIDIA's $112 billion acquisition is monumental, and any misstep in execution could negate the perceived benefits, yet the market assumes flawless integration. This assumption is not grounded in reality. It is grounded in desire and expectation. Valuation also requires understanding the limits of AI and compute demand. Market hype often presents AI as an insatiable growth engine, a technology that will expand revenue indefinitely. While AI is transformative, demand is not infinite. Enterprise adoption, hardware limitations, software maturity, and regulatory considerations all impose constraints. True valuation must model realistic adoption curves, marginal revenue from incremental AI deployment, and the eventual plateauing of demand. Ignoring these limits inflates market expectations and widens the gap between perception and reality. Financial leverage compounds the problem. If NVIDIA financed any portion of the acquisition through debt, it introduces interest obligations that reduce net cash flow. Even if the company used cash reserves, the opportunity cost of tying up such enormous capital in a single acquisition must be considered. True value accounting includes the cost of capital, the potential dilution of equity, and the long-term financial flexibility of the company. Market hype, by contrast, rarely incorporates these subtleties. It treats acquisitions as purely additive to value, ignoring the constraints they impose. Investor psychology is another critical factor. Humans are inherently drawn to narratives of technological inevitability. AI is the perfect story. It is exciting, futuristic, and promises outsized returns. When combined with NVIDIA's brand, leadership, and historical performance, the narrative becomes irresistible. Investors ignore red flags, dismiss risk, and extrapolate past growth into an unbroken future. This psychological bias inflates stock prices beyond intrinsic value and creates the dangerous illusion that NVIDIA's future earnings are guaranteed. The media plays a reinforcing role. Headlines celebrate the acquisition, analysts produce glowing reports, and commentators frame NVIDIA as the poster child for technological progress. Skepticism is marginalized. The amplification of optimism creates a feedback loop where hype is validated by rising prices, and rising prices reinforce hype. Rational valuation is drowned out by a chorus of approval, yet when market sentiment shifts, as it inevitably does, the fall can be swift and severe because the underlying cash flows never justified the price. To quantify the disconnect, one must construct a discounted cash flow model using conservative assumptions, realistic growth rates, reasonable margins, integration risk, competitive pressures, macroeconomic cyclicality, and capital costs. Under such a model, NVIDIA's intrinsic value falls well below the market price implied by current hype. The market is paying for the perfect execution of a story, not the measured outcomes of the business. And history is clear. Stories eventually fail when reality asserts itself. Even if the AI revolution accelerates, if competitors gain traction, if macro conditions deteriorate, or if integration stumbles, the gap between true value and market perception will widen, and investors will face losses. The magnitude of the acquisition amplifies this effect, because a $112 billion bet leaves little room for error. The higher the price, the more unforgiving the market becomes when expectations are unmet. Finally, the lesson here is timeless. Market hype rarely aligns with true value. Price reflects expectations, but expectations are fragile, malleable, and often unrealistic. NVIDIA's story is compelling, but it is not guaranteed. The acquisition, the stock price, and the optimism are all contingent on perfect execution and uninterrupted growth. True value requires skepticism, careful modeling, and a recognition of risk. Market hype thrives on narrative. It does not reward realism. Investors who confuse the two are exposed to significant downside. Lessons from past bubbles that echo today: history does not repeat itself, but it rhymes. I have spent decades observing the patterns that repeat across financial markets, not because investors are irrational, but because human psychology and institutional incentives rarely change. When I look at NVIDIA's $112 billion acquisition, the irrational exuberance surrounding AI, and the disconnect between market price and intrinsic value, I cannot help but be reminded of the bubbles that came before. From the dot-com boom to the housing crisis to the tech mania of recent years, each episode offers lessons that are as relevant today as they were then. The fundamental behaviors, the overestimation of future growth, the underestimation of risk, and the structural reinforcement of optimism are nearly identical. Yet history is largely ignored by Wall Street, as though the past was an anomaly rather than a template for predictable mistakes. Take the dot-com bubble of the late 1990 seconds, for example. Companies with no earnings, no path to profitability, and sometimes no product at all were valued at billions of dollars simply because the market believed in their potential. Investors, analysts, and media outlets collectively elevated story over substance. A company's worth was measured not by its fundamentals but by its narrative. Every IPO was celebrated, every press release dissected as evidence of genius, and every analyst reassured investors that the future could not possibly be disappointing. The underlying risks were ignored. Execution risk, competition, operational feasibility, none of these mattered as long as the story was compelling. NVIDIA's current situation echoes this. The company is profitable, yes, and its products are real, but the stock price and the $112 billion acquisition are priced not for current earnings or measured growth, but for perfection in execution and market dominance in AI. The parallels are unmistakable. The 2008 housing bubble offers another stark lesson. Investors believed mortgage-backed securities were safe because ratings agencies gave them AAA ratings. Banks and funds piled into complex financial instruments without fully understanding their structure. The underlying assets, subprime mortgages, were assumed to perform indefinitely, ignoring historical data, demographic trends, and macroeconomic risks. When the assumptions failed, the losses were catastrophic. The lesson is clear. Complexity can disguise risk, and mass belief in an asset class can blind both professionals and the public to vulnerabilities. Today, NVIDIA's valuation and acquisition are wrapped in complexity AI forecasts, synergy assumptions, global market expansion, and technological dominance, all of which are difficult to verify independently. The complexity itself is used as a shield against criticism, just as complex financial instruments were in 2008. The lessons from Japan's asset bubble in the 1980 seconds are also instructive. Real estate and stock prices rose to levels divorced from any reasonable fundamental assessment. The collective enthusiasm, fueled by easy credit and cultural narratives about inevitable growth, created a feedback loop that made risk invisible. When the bubble finally burst, prices fell for decades, eroding wealth and constraining growth. Bubbles are not just short-term distortions. They can have long-term consequences. The AI hype today, combined with enormous acquisitions like NVIDIA's, mirrors this phenomenon. Investors are pricing perfection, but the reality is that execution risk, market saturation, competition, and macroeconomic variables could lead to significant corrections, the effects of which would be felt for years. Every bubble shares a similar psychological pattern. First, a new opportunity emerges: technology, real estate, or a financial innovation. Early adopters make rational investments, often reaping outsized rewards. Second, early success stories attract attention and narrative overtakes analysis. Investors begin to extrapolate past growth into the future without accounting for diminishing returns, competition, or unforeseen risks. Third, institutional and regulatory structures reinforce optimism. Analysts, ratings agencies, fund managers, and media outlets all become participants in a feedback loop that rewards bullish behavior and punishes skepticism. Fourth, the bubble reaches its peak when investors assume that risk has been eliminated entirely. Fifth, reality intrudes, sometimes suddenly, sometimes gradually, exposing the gap between expectation and intrinsic value. NVIDIA's current market and acquisition behavior fits neatly into this sequence. Consider the tech bubble of the mid-2010 seconds. Cloud computing, AI, and semiconductors were elevated to almost mythical status. Growth rates were extrapolated to infinity, valuations ignored cash flows, and any sign of risk was rationalized as temporary or irrelevant. Companies were expected to dominate markets perfectly, without error or competition. The enthusiasm created a structural blind spot where investors could not imagine a scenario in which assumptions failed. The market now exhibits the same blind spots regarding NVIDIA and AI. Investors are betting that NVIDIA will execute perfectly, maintain technological dominance, integrate the acquisition seamlessly, achieve unprecedented growth, all simultaneously. History suggests this is highly unlikely. One of the most important lessons is that market sentiment is a poor proxy for risk. Optimism tends to peak at the worst possible time. Just as in the dot-com bubble or the housing crisis, euphoria often coincides with maximum vulnerability. When the crowd is at its most confident, risk is usually underestimated, leverage is high, and even small negative shocks can trigger significant corrections. In NVIDIA's case, the hype surrounding AI, the acquisition, and stock performance has reached levels that are rarely sustainable. The higher the collective confidence, the more exposed investors become to disappointment. Another recurring theme across bubbles is the failure to price in execution risk. Management decisions, integration challenges, and operational realities are often simplified or ignored during periods of optimism. In past bubbles, executives were lauded for bold moves, even when those moves were reckless, because narrative rewarded audacity. The $112 billion acquisition by NVIDIA is being praised in similar fashion. Analysts and investors assume that large-scale execution will be flawless, ignoring historical evidence that integration of complex, multi-billion-dollar acquisitions almost never goes perfectly. The market fails to account for the probability of missteps, delays, or unforeseen complications. Bubbles also illustrate the dangers of leverage and overextension. Whether it was mortgage debt in 2008, margin in the dot-com era, or corporate borrowing during the Japanese bubble, the principle is the same. The larger the exposure, the greater the downside when expectations are unmet. NVIDIA's acquisition represents not only a financial commitment, but also a strategic concentration of risk. Even if the company maintains profitability, the opportunity cost, execution risk, and dependency on perfect market conditions amplify potential downside. Investors often ignore these factors because the narrative masks them, but history shows that concentrated bets of this magnitude rarely produce flawless outcomes. Cultural and psychological reinforcement plays a significant role in bubble formation. Herd behavior is a powerful force. Humans are social creatures, and professional investors are no exception. When everyone around you is buying, projecting growth, and celebrating innovation, it becomes psychologically difficult to dissent. Skeptics are labeled as bearish, contrarian, or pessimistic, and their warnings are marginalized. This dynamic has been observed in every major bubble, from tulip mania to the internet stock craze to subprime mortgages. Today, NVIDIA sits at the center of a similar ecosystem of reinforcement. Analysts, media, and investors collectively validate the story, suppress skepticism, and magnify the hype. Macro conditions are also rarely accounted for during bubbles. Easy credit, low interest rates, and abundant liquidity often fuel overvaluation. The absence of constraints encourages excessive risk-taking. The current environment of low rates, relative to historical averages, and abundant capital for tech investments parallels these historical periods. The conditions are right for elevated valuations, stretched assumptions, and collective blindness to risk. Once macro conditions shift, as they inevitably do, the gap between market pricing and intrinsic value becomes exposed. The lessons from past bubbles converge on one point. Market hype is not a substitute for intrinsic value. Price can diverge from fundamentals for extended periods, but eventually reality asserts itself. Companies that are overvalued, acquisitions that are overpriced, and technologies that are hyped without constraint all face the same reckoning. The $112 billion acquisition by NVIDIA, coupled with extraordinary market enthusiasm, fits the pattern perfectly. Investors are effectively paying for perfection, ignoring risk, and placing faith in a narrative rather than measurable outcomes. History demonstrates that such situations often end poorly. Finally, the most enduring lesson is humility. Markets are not rational, but they are unforgiving. Enthusiasm is fleeting, narratives collapse, and losses can be severe when expectations fail to align with reality. Every bubble teaches the same fundamental truth. Human behavior, institutional incentives, and cognitive biases create recurring patterns of overvaluation and collective blindness. NVIDIA's situation, magnified by its acquisition, high valuation, and AI hype, is a textbook example. To succeed, investors must resist the allure of story over substance, critically assess intrinsic value, and prepare for outcomes that deviate from the prevailing narrative. What investors must do before it's too late. When I speak about what investors must do before it's too late, I am not talking about abstract theories or vague warnings. I am talking about the taking concrete steps, the mental frameworks, and the disciplined skepticism that separates those who preserve capital from those who lose it during periods of market mania. The situation surrounding NVIDIA, its $112 billion acquisition, and the broader AI hype is the culmination of forces that have historically led to catastrophic losses for investors who fail to recognize the gap between price and intrinsic value. This is not speculation. This is pattern recognition, grounded in decades of observing bubbles, extreme valuations, and the human behavior that fuels them. The first and most fundamental principle is this: understand intrinsic value and distinguish it from market price. Intrinsic value is not an opinion. It is a measurement derived from a company's fundamental cash flows, its realistic growth potential, operational risks, competitive environment, and macroeconomic factors. Market price, by contrast, is the product of collective sentiment, momentum trading, narrative hype, and short-term speculation. Investors often confuse the two, particularly when enthusiasm is high and narratives are compelling. The $112 billion acquisition by NVIDIA is a textbook case where market price has been elevated far above intrinsic value due to hype surrounding AI, perceived technological indispensability, and the general bullish sentiment in tech. Before committing capital, investors must conduct a rigorous, conservative assessment of intrinsic value. They must model future cash flows under multiple scenarios, discount these cash flows for risk and uncertainty, and determine whether the market price reflects a reasonable margin of safety. This leads directly to the next critical step: adopt a skeptical mindset toward consensus projections. Analysts are projecting extraordinary growth rates in AI, GPUs, and data centers, often assuming uninterrupted dominance, flawless execution, and zero competitive interference. These assumptions are heroic, bordering on fantastical. Investors must recognize that Wall Street incentives favor optimism, not realism. Analysts are rewarded for bullishness, not caution, and dissenting voices are marginalized. Skepticism is therefore not just prudent, it is necessary. Question the assumptions behind revenue projections, synergy expectations, and market share forecasts. Evaluate the plausibility of achieving these outcomes given historical precedent, competitive pressures, and macroeconomic conditions. Skepticism is the most reliable defense against overvaluation and collective irrationality. Investors must also quantify risk. not just general risk, but specific, measurable risk factors. This includes leverage, integration risk, dependency on market height, regulatory exposure, technological obsolescence, and cyclical vulnerabilities. NVIDIA's $112 billion acquisition represents a concentration of risk. Even if the company's core business remains strong, the acquisition introduces operational complexity that could disrupt cash flows and earnings. Quantifying risk involves scenario modeling, best case, base case, and worst case outcomes. It involves stress testing assumptions, examining the impact of delays or failures in integration, and evaluating how sensitive the company's valuation is to variations in growth, margins, and competition. Investors must treat risk as tangible, not abstract. Liquidity and capital preservation are central to surviving periods of market mania. Investors should avoid committing capital that they cannot afford to lose, or that could force them into panic selling during corrections. Markets that are detached from intrinsic value can remain irrational for longer than expected, but when reality asserts itself, declines can be steep and sudden. NVIDIA's stock, inflated by AI hype and acquisition optimism, is vulnerable to such corrections. Investors who prioritize liquidity, who maintain positions they can hold through volatility, are far better positioned to withstand market dislocations. Preserving capital is not passive, it is active risk management. Diversification, though often discussed, must be applied with discipline. Many investors diversify superficially, holding a basket of high-beta tech stocks and assuming they are insulated from risk. True diversification involves exposure to uncorrelated assets, a balance between growth and defensive positions, and allocations informed by risk rather than narrative. In a market obsessed with AI and high-profile tech acquisitions, diversification is particularly important because the hype is concentrated in specific sectors. A correction in AI-driven valuations could affect multiple companies simultaneously. Diversification is therefore not optional, it is a structural necessity. Historical context provides crucial guidance. Every major market bubble demonstrates the same behavioral patterns. Extreme optimism, concentration of capital, underestimation of risk, and eventual sharp correction. Investors must study these cases, .com, housing, Japanese assets, and others, not as anecdotes, but as empirical evidence. History does not repeat exactly, but it reliably illustrates human tendencies. NVIDIA's valuation and acquisition behavior echo these patterns. Investors who ignore lessons from past bubbles risk repeating the same mistakes. Understanding the psychology of markets is as important as understanding financial statements. Another critical consideration is the alignment between management incentives and shareholder outcomes. Companies often pursue acquisitions, stock buybacks, or aggressive growth strategies that benefit executives, particularly in the short term, at the expense of long-term shareholders. NVIDIA's management may believe that the $112 billion acquisition will cement their technological leadership, but investors must ask whether it aligns with their own interests. Does the deal create sustainable value? Does it introduce unnecessary leverage or operational risk? Are executives incentivized for long-term performance, or do short-term stock movements guide their decisions? Misaligned incentives often precede poor outcomes, and investors must scrutinize them carefully. Margin of safety is a principle that cannot be overstated. No investment should be made at a price that assumes perfection. Investors must account for errors, unforeseen events, and external shocks. Even minor deviations from assumptions in growth, profitability, or integration can dramatically affect value, particularly in high-priced acquisitions. The $112 billion spent by NVIDIA magnifies this reality. Investors who fail to apply a rigorous margin of safety are effectively betting on perfection, which history shows is rarely sustainable. Margin of safety is protection against the inevitable uncertainty of markets. Scenario planning and sensitivity analysis are indispensable tools. Investors must model multiple outcomes, including adverse scenarios, slower AI, adoption, integration delays, competitive breakthroughs, regulatory constraints, or macroeconomic downturns. Understanding how each scenario affects valuation and risk exposure allows investors to make informed decisions and avoid the trap of collective optimism. It is not enough to hope for the best. Preparation for the worst is essential. NVIDIA's acquisition is a high-stakes event precisely because it reduces room for error. Scenario planning helps quantify and mitigate that risk. Investors must also resist narrative-driven trading. The market is full of stories. AI is the future. NVIDIA is indispensable. This acquisition will redefine technology. While stories can be compelling, they are not evidence. Investing based on narrative, rather than fundamentals, is speculation, not investment. The ability to separate emotion from analysis, to evaluate price relative to intrinsic value, and to act independently of the herd is what differentiates successful investors from those who lose. Capital during corrections. Monitoring external risk factors is critical. Macroeconomic shifts, interest rate movements, geopolitical tensions, and regulatory interventions can all affect company performance and market valuations. NVIDIA, as a global technology leader, is subject to these risks. Investors must maintain awareness of these external variables, integrating them into valuation models and risk assessments. Ignoring external risks is a frequent mistake during bubbles, when optimism blinds participants to the very forces that could trigger a market correction. Finally, patience and discipline are required. Markets are not efficient in the short term. They can remain irrational far longer than any investor expects. Acting prematurely, reacting to hype, or chasing momentum often leads to losses. Investors must have the discipline to wait for opportunities that present a favorable risk-reward balance, to act when price diverges significantly from intrinsic value, and to avoid the trap of emotional trading. In periods of height, patience is not passivity. It is strategic positioning. In summary, what investors must do before it's too late is a combination of rigorous analysis, skepticism, risk quantification, capital preservation, diversification, historical awareness, alignment evaluation, margin of safety application, scenario planning, narrative resistance, external risk monitoring, and disciplined patience. NVIDIA's $112 billion acquisition, combined with AI market mania, represents a situation where the difference between success and failure is magnified. Investors who adhere to these principles protect themselves from the consequences of collective irrationality, mispricing, and operational risk. The lesson is timeless. The market may ignore risk today, but it will not ignore reality forever. Preparation, analysis, and discipline are the only safeguards against the inevitable reckoning.